What's the outlook for the stock market in 2014, and what should you be buying? I'm Jack Otter, editor of BARRON'S.com. I'm here with Scott Black, the founder and Chief Investment Officer, Chief Executive Officer, Chief Everything at Delphi Asset Management in Boston. Scott, you're a very close observer of the political scene. So maybe let's start there. How do you see politics and the market and the economy intersecting in the coming year?
Well, I would hope that both the Republicans and the Democrats will get together on raising the debt ceiling, because we don't want another crisis. We had one about 2.5 years ago, and peak to trough, the market dropped about 17.3%. I actually think, because the onus now is on the Democrats with the rollout of Obamacare and how botched it is, the Republicans basically are in the driver's seat when it comes to the midterm elections, and I don't think they want to upset their own potential chances here. On the international front, my biggest concern is that Iran may be getting closer to a nuclear bomb, notwithstanding this pact that they've signed with the G5+1. And it's possible that Israel could act unilaterally. I don't have perfect information, but I don't think that Israel is going to tolerate a nuclear Iran.
Yeah, that's a scary thought. It would almost make one just run straight to Treasury bonds. But if you are an equity investor, where do you see opportunity in 2014? Well,
let's start with the market as a whole. If you look at the S&P 500, and we're using basically 8% growth in earnings this year, the street estimates are much too high at 116. The S&P on Friday closed at about 15.9 times expected earnings, which by historical norms is moderately priced. It's been 16 in the post-war era. Plus, nominal interest rates are still low. So I think there's room for both growth in earnings per share and also multiple expansion. During the roundtable today, I said I think it's realistic, barring some external shock, you could see a 10 or 15% increase. One caveat is that both mid-cap and small-cap stocks, as defined by the 2,500 and by the 2,000, are expensive. They're roughly 21 times expected earnings of this year. Doesn't mean there aren't individual names, but as a whole, they've had a terrific run-up.
Even large cap has done well, but small cap has done even better. But you're looking at names. You are a stock picker, so you've looked at some large cap names and some small cap names that you like. You want to name some?
Well, a little company. It's an exploration company. We got it at 13. It's up to 44. Is Bonanza Creek. It's basically in the Wattenberg, based in Colorado. It's an exploration and production company, more heavily leveraged to oil and natural gas liquids, over 70% of the production relative to gas, which is under 30%. The production this year will grow at about 59%. The exit rate should be around 29,000 barrels a day, up from roughly 18,500 with an average of 24,000 barrels a day. They're highly profitable. It's not a question of just expanding the reserves. They should do about $3.10 in actual earnings per share, which puts it around a 14p. But the better metric was called discretionary cash flow. When you add back depreciation, amortization, deferred tax, and dry hole expense, they will do to close to $10. It's a giveaway at 4.5 times discretionary cash flow. Ordinary companies with very little drill bit growth sell at 6 and 7 times. They will have slight negative free cash flow because they have an aggressive drilling program this year of about $575 million. So they have a hole where they're outspending their cash flow by about $150 to $200 million. But it's a solid balance sheet. It's not heavily leveraged. Net debt equity is about 0.5. So there's room to add a little bit of debt on the balance sheet. And actually, they have enough cash to close the hole at this point.
So clearly, the market is well aware that there's an energy boom going on in that part of the world. What do you think it is that Mr. Market isn't quite assigning the valuations that these companies deserve?
Well, I think it's an individual thing. Bonanza Creek is not a household name. It went public less than 2 years ago. I don't think there are that many analysts that actually follow it, because we've had the management into Boston to see them, and I've talked to them recently as well. So I think there's an inefficiency in the market.
Gotcha. Can you give us another pick?
Another one that I like is KLA-Tencor. I was out to see them in the San Francisco area several months ago. I've talked to them twice recently. They're the leader in what's called metrology, which is the optical inspection of the front end of the chip. Now, a couple of things are important. There are two drivers here. One, we're shrinking the die size from 0.28 mu nano down to 20. Actually, Intel internally has actually gone to 12 nano for its latest and greatest, and they're also moving from what's called planar, which is two-dimensional chips, into what's called 3D. And these are big drivers for equipment. Our outlook for the year for WFE is only 30 to 32 billion, and we think that KLA is only going to grow. It's a fiscal year ending in June of this year, top-line revenue of about 10%. If you back out the excess cash, and they do not have stock-based comp in their GAAP numbers like many of the companies, the stock is still selling at roughly 12 times this year expected earnings. And if you think that the follow-on year on wafer fab will be around 35 billion, the earnings can explode. And what we're doing here is we're catching the inflection point on the earnings per share. The quarter that just ended in December will probably be the first up quarter year over year in a long time at KLA.
And presumably that they're working on not only the PC, which those chips are slowing down, but they've got some inroads into mobile as well?
It has to do with across all types of chips. Foundry and logic are 70%. Memory is only 30% of the business. And what's interesting, for every incremental dollar in revenue at this point, they drop 50 cents in incremental profit to the pre-tax line. There's huge operating leverage in the business.
Wow. Thanks very much, Scott.
Thank you.